All right, get ready to dive into the world of investing.
With the OG himself?
Benjamin Graham and
Yes.
his masterpiece, The Intelligent Investor.
A classic.
You've sent over such an interesting collection of excerpts here
Oh, yeah.
from like historical market data
Uh,
to stories about companies like Chrysler and A&P.
it's quite the mix.
So get ready to maybe have your investing brain rewired a little bit because
Yeah.
we're about to unlock some really timeless wisdom here.
It's amazing how relevant his insights are, even in today's market.
It really is.
Yeah,
Let's set the stage a little bit before we jump into all the details.
sure.
Now, most people know Benjamin Graham as like a Wall Street legend, right?
Of course.
But he was more than just a successful investor.
Hmm.
He lived through some of the most turbulent periods in financial history,
Yeah.
like including the 1929 crash.
I can only imagine how those experiences shaped his views on investing.
Totally.
He saw firsthand the dangers of speculation
Yeah.
and the importance of a disciplined, value-oriented approach.
Mm-hmm.
That's the heart of his philosophy, really
Yeah.
intelligent investing versus reckless gambling.
Yeah.
And that's a thread that we'll see kind of woven throughout all these excerpts you picked out.
And I've always been fascinated by market history.
Oh, yeah.
So I'm looking forward to exploring that part of Graham's analysis.
Well, you picked some great excerpts that highlight exactly that.
Oh, good.
We'll be looking at the market performance between 1949 and 1970,
Okay.
a period of incredible growth,
Huge growth.
but also the 1969-1970 bear market,
Oh, right.
a stark reminder that what goes up
Can come down.
can also come down.
Ouch. Yeah, those market crashes can be brutal.
They can be rough.
Speaking of cautionary tales,
Yeah.
Graham really seems to hammer home the difference between investing and speculating.
Uh-huh.
It's almost like he's allergic to hype.
Well, having lived through those wild market swings, can you blame him?
I guess not. No.
He compares speculation to gambling, which,
Right.
not exactly a recipe for long-term success.
It makes you wonder, like, why do people keep falling into that trap? Is it just human nature to chase those shiny, get-rich-quick schemes?
It's definitely tempting, especially when you see other people
right.
seemingly making a killing.
Like during the dot-com bubble.
The dot-com.
Everyone was piling into internet stocks with no earnings.
Sometimes no real business model.
Don't remind me.
You got caught up in it too.
I got caught up in that a little bit myself, yeah.
Yeah.
It felt like the party you didn't want to miss, and then
Then,
the music stopped.
oh no.
And everyone was scrambling for the exits.
It's a classic example of speculation run wild.
Yeah.
And it's not just a thing of the past either.
Oh, really?
We see similar patterns today,
Like what?
with the hype around certain meme stocks
Oh,
or
right.
cryptocurrencies.
So how do we avoid those pitfalls then?
Right.
What does it actually mean to be an intelligent investor?
According to Graham,
Yeah.
well, he's very clear that it's not about having
Okay.
genius level IQ.
Okay.
It's about cultivating specific traits,
Okay.
patience, discipline,
Mm-hmm.
and eagerness to learn.
Yeah.
And maybe most importantly,
Yeah.
the ability to control your emotions and think independently.
So it's more about temperament than raw brain power.
Exactly.
That's reassuring.
It is.
Because, frankly, some of those financial reports make my head spin.
Oh, yeah.
It's like learning a whole new language.
Yeah.
That's where Graham's emphasis on independent thinking comes in, right?
Exactly. Exactly.
He actually warns against blindly following the advice of brokers or financial services.
Mm-hmm.
Really?
Yeah.
Because you'd think those would be the people to trust.
You would think so, but Graham saw how their interests don't always align with those of individual investors.
Right.
He stresses the need to do your own research.
Mm-hmm.
Understand the businesses you're investing in.
Okay.
And not rely solely on someone else's opinion,
Especially when it comes to hot tips
especially those.
and market forecasts.
Yeah, they're always swirling around.
So how can we learn to think for ourselves when it comes to investing then?
Well, one of the most important tools is understanding market history.
Okay.
Graham spent a lot of time analyzing market cycles
Yeah.
and how investors often make the same mistakes over and over again.
Oh, that's got to be frustrating.
He saw this tendency during the booming market between 1949 and 1970.
Okay.
While those years saw amazing returns,
Right.
he cautioned that they didn't guarantee similar results in the future.
That makes sense. It's easy to get caught up in the excitement of a bull market
And think it'll last forever.
That's right.
So where can studying market history actually pay off?
Well, it helps you recognize patterns.
Okay.
Spot potential warning signs.
And develop a healthy respect for the market's ability to
Two,
both reward and punish.
so how can we use history to inform our investment decisions today?
Take the 1969-1970 bear market, for example.
Okay.
A lot of investors believe that that leading stocks were invincible.
Oh, really?
They assumed any dip would quickly rebound.
Wow.
But then the market plunged 35%,
Oh.
shattering that illusion.
So learning from events like that.
Can help you avoid
Yeah.
falling into similar traps.
That's a good point. It's like that saying, those who cannot remember the past are condemned to repeat it.
Exactly.
But studying history can feel overwhelming. Like, where do you even begin?
Well, Graham himself provides a great starting point in The Intelligent Investor.
Okay.
He digs into specific historical periods,
Okay.
analyzes market trends,
Mm-hmm.
and shows how those lessons can be applied to current situations.
So if we're trying to become more intelligent investors,
Yes,
should we be reading up on past market crashes and bubbles?
absolutely.
Okay.
And the beauty of Graham's book is that he connects those historical examples
Yeah.
to practical investment principles.
Okay.
One of the most important being his famous margin of safety principle.
Oh, yeah. I've heard that term thrown around a lot.
It's a big one.
Can you break down what that means exactly?
It's all about buying assets for significantly less
Less than.
than their intrinsic value.
Okay.
This buffer helps cushion you against those inevitable market swings
Right.
and mistakes in judgment.
Yeah, make some mistakes.
It's like having a built-in safety net for your investments.
That sounds incredibly important, especially in volatile markets.
It is.
I'm guessing this principle is a key part of
Why?
why Graham was so skeptical about relying solely on per share earnings.
You got it.
Okay.
He warned that those figures
Mm-hmm.
can be manipulated
Oh.
or distorted by accounting decisions.
Right, right.
For example, he analyzed Trainco in 1970.
Okay.
They shifted their depreciation method,
Mm-hmm.
and suddenly their earnings looked much better on paper,
Really?
even though their underlying business hadn't really changed.
So it's like they were putting lipstick on a pig. Just
Exactly.
making their number
Look better than they actually were.
better than they actually were.
And Graham stresses the importance of
Oh.
looking beyond the headlines
Okay.
and digging deeper into how companies present their numbers.
Mm-hmm.
You need to understand what's really driving those earnings.
So if we can't always trust reported earnings,
Right.
what should we be looking at instead then? What are the key indicators of a company's true value?
Well, that's where things get really interesting, and that's where we'll pick up in part 2 of our deep dive.
Now you've got me hooked.
All right,
Can't wait to dive back in and uncover those secrets.
let's do it.
All right, so we're back, and I'm ready to unlock these secrets to valuing companies like a pro. Where do we even begin?
Well, Graham provides a really comprehensive framework in The Intelligent Investor,
Okay.
and he actually distinguishes between
Okay.
two kinds of investors:
Two. Okay.
the defensive investor
Mm-hmm.
and the enterprising investor.
I remember you mentioning that before.
Yeah.
It sounds kind of like choosing your player in a video game.
Yeah.
So who is this defensive investor that Graham talks about?
So think of the defensive investor as someone who prioritizes safety and simplicity
Mm-hmm.
above all else.
Okay.
They're not looking to spend hours poring over financial statements
Right.
or trying to outsmart the market.
Right.
They want a solid, reliable portfolio
Yeah.
that delivers consistent returns over the long term.
Okay. That sounds like me on most days.
Yeah.
So what kind of investments would fit into that defensive portfolio?
Graham suggests a mix of high-grade bonds
Okay.
and a diversified selection of large, well-established companies.
Big, solid companies.
Yeah, he even suggests considering investment funds or common trust funds
Okay.
as a way to just
Simplify.
simplify things even further.
He specifically mentions U.S. savings bonds, right?
Yeah, those used to be kind of a staple
Yeah.
for conservative investors.
Yeah. Yeah.
And while the specific types of bonds might change over time,
Right.
the underlying principle remains the same:
Which is?
seeking out investments with a high degree of safety
Mm-hmm.
and a predictable return.
So it's about building that solid foundation,
Exactly.
like the bedrock.
Yes.
Okay.
And once you have that foundation in place,
Then you can.
then you can decide if you want to take a more active role
Yeah.
in your investments.
Okay. So that's where the enterprise investor comes in.
That's right.
Okay.
The enterprising investor is more of a hands-on type,
Yeah.
someone who's ready to roll up their sleeves
Oh, right.
and dig into those financial statements.
Okay, so they're like the treasure hunters.
Precisely.
Okay.
They're still focused on um, value investing and minimizing risk,
Yeah.
but they're also seeking out opportunities
Right.
to potentially outperform the market.
I like that, the treasure hunters of the investing world.
Yeah.
So where do these treasure hunters begin their search?
Well, Graham suggests several strategies,
Like what?
including looking for undervalued growth stocks,
Okay.
bargain issues,
Mm-hmm.
and those special situations we talked about earlier,
Mm.
like mergers or acquisitions.
Okay.
But he's also clear that
Yeah.
even the most enterprising investors need to be disciplined.
Right. They can't just go chasing after every shiny object.
That's right.
So what are some of those clues we should be looking for then? How do we go about analyzing a company's financial statements, like a true
Like a true.
Graham-style investor?
Well, he dedicates several chapters
Okay.
to dissecting financial statements,
Okay.
looking at earnings, assets, debt,
Right.
all the other factors
Yeah.
that contribute to a company's intrinsic value.
I have to admit, that's the part that always intimidates me.
Really.
It feels like you need a degree in accounting
Oh, yeah.
to understand those reports.
It can be overwhelming, but Graham actually makes it quite approachable.
Does he?
Yeah, he breaks down those complex concepts
Okay.
into simple terms
Okay.
and even walks you through specific examples,
Okay, like what?
analyzing real companies like
Mhm.
Chrysler,
Okay.
AMP, National General.
He even tackles companies that were struggling, right?
He does.
I remember him analyzing the Penn Central Railroad,
Oh, yeah?
that company that was considered like a rock solid investment
Mm-hmm.
for over a century,
And
then went bankrupt.
I'm bankrupt, yeah.
And by digging into those financial statements, he saw the warning signs that many others missed.
That's right.
It's a reminder that even seemingly stable companies
Mm-hmm.
can harbor hidden risks.
Absolutely.
So it's not enough to just look at a company's stock price
Right.
or just read the headlines.
You got to go deeper.
You really have to go deeper under the hood
Right.
to understand what's going on.
Exactly. And Graham provides you with the tools
To do just that.
to do just that.
So he teaches you how to assess a company's
Assessing.
financial health,
Uh-huh.
profitability, its debt levels,
Yeah,
and its potential for future growth.
that's right.
He even gets into the relationship between shareholders and management, which I
Yeah.
find that fascinating.
Yeah.
What was his take on that relationship?
He believed that shareholders have a right
Okay.
to hold management accountable.
Okay.
He encourages investors
Yeah.
to question decisions,
Okay.
attend shareholder meetings,
Okay.
and even advocate for change when necessary.
That's pretty bold for a book written in the mid-20th century.
It is.
It's like he's saying, don't just be a passive investor.
Yeah.
Be an active owner
Be an active owner.
of the business you're invested in.
That's exactly it. He wants investors to
Yeah.
think like business owners,
Okay.
not just stock traders.
To understand the value
Right.
of the assets they're buying into.
That's right.
And to be active participants in the companies they own.
Exactly.
And he placed a lot of importance on dividends, right?
He did.
What was that all about?
He saw dividends as, as a tangible sign
Okay.
of a company's profitability
Mm-hmm.
and its commitment to returning value to shareholders.
Okay.
He argued that companies should be paying out
Mm-hmm.
a reasonable portion of their earnings
Okay.
as dividends
Right.
rather than hoarding cash
Right.
or squandering it on ill-conceived acquisitions.
So it's like you're getting a share
A share.
of the profit
Exactly.
just for being an owner.
That's right.
That makes sense.
And it goes back to his belief in shareholder rights
Right.
and the importance of management acting in the best interests
Yeah.
of the owners.
So we've talked about the defensive investor,
Yeah.
the enterprising investor,
Uh-huh.
how to analyze financial statements like a pro.
Right.
But I'm curious.
Yeah.
How does all this apply to us today
Right.
in a world that's, vastly different from the
Uh-huh.
one Graham was writing in?
Good question.
I mean, we have technology and access to information
We do.
that he couldn't have even dreamed of.
It's true. The investing landscape has changed dramatically.
Yeah.
But Graham's core principles
Yeah.
remain remarkably relevant.
Okay.
The need for discipline, patience,
Right.
and a focus on value is just as important today
Right.
as it was back then.
But while we have, more tools and information at our disposal,
We do.
it also creates new challenges.
Like what?
Like, what are those challenges?
Well, it's easy to get overwhelmed
Yeah.
by the sheer volume of information
So much information out there.
and the constant noise
Okay.
of the market.
24/7 news cycle. Yeah.
There are so many opinions,
Yeah.
so many experts
Right.
telling you what to do that it can be hard to know who to trust.
Yeah. Who to trust, what to believe.
Exactly.
How do we cut through all that noise then?
Right.
And make sound investment decisions?
That's where having a solid framework,
Mm-hmm.
a set of guiding principles,
Okay.
like those that Graham outlines in The Intelligent Investor,
Right.
becomes crucial.
Okay.
It's about tuning out the hype,
Mm-hmm.
the short-term fluctuations,
Right.
and focusing on the fundamentals of value investing.
So it's almost like we need to become more discerning,
Yes,
more critical of the information
more critical.
that we bombarded with.
Exactly, and that's where the principles of independent thinking
Yeah.
and doing your own research that we talked about earlier
Yeah.
becomes so important.
And speaking of doing your own research,
Yeah.
one of the most fascinating parts of The Intelligent Investor
Yeah.
is the appendix on the super investors of Graham and Doddsville.
Oh, I love that chapter.
I'd love to hear more about that.
It's a truly inspiring chapter.
Yeah.
It profiles a group of investors
Okay.
who achieved extraordinary success
Okay.
by following Graham's principles,
Wow.
despite having very different investing styles.
Like who?
Well, you've got Warren Buffett in there,
Oh, right.
famous for his concentrated long-term bets.
Yeah.
And then you've got Charlie Munger,
Right. His partner.
Bussett's partner,
Yeah.
who takes a more diversified approach,
Okay.
spreading his investments
Okay.
across a wider range of companies.
So different approaches.
And then there's Walter Schloss,
Okay.
who focuses on finding deeply undervalued stocks,
Okay.
often in overlooked or out-of-favored industries.
So despite their differences, they all had that common thread.
They did.
A deep understanding of Graham's principles
And
a commitment to buying businesses.
That's right.
Not just stocks.
not just stocks.
It's almost like they were all speaking the same language,
Yeah.
even though their accents were different.
I like that analogy.
And so it just highlights the power of Graham's approach.
It does.
It's not a rigid formula,
Right.
but a flexible framework
Right.
that can be adapted to different investment styles
Absolutely.
and personalities. It's really encouraging to see that ordinary people
Yeah,
can achieve extraordinary results
they can.
by following a sound investment philosophy.
That's the beauty of Graham's message.
What is?
That it's accessible to anyone
Okay,
who's willing to put in the time and effort
right.
to learn.
Okay, so
Huh?
we've covered a lot of ground here.
We have.
From the defensive investor to the enterprising investor.
Yes.
From analyzing financial statements to understanding the power of dividends.
Mm-hmm.
But before we wrap up this part of our deep dive,
Okay.
what's a one key takeaway
Yeah.
you want our listeners to walk away with?
I think the most important takeaway is that investing
Yeah,
doesn't have to be
doesn't have to be.
complicated or intimidating.
Okay.
Graham's approach
Yeah.
is all about common sense,
Okay.
discipline,
Mm-hmm.
and a long-term perspective.
Okay.
It's about tuning out the noise of the market
Right.
and focusing on the fundamentals of value investing.
And it's about being an active and engaged owner, right? Holding management accountable.
Yeah.
Advocating for your own interests.
It's like taking ownership of your
Correct.
financial
Good.
future
Your financial future, yeah.
instead of letting the market dictate your decisions.
That's great advice.
And remember,
Yeah.
even the most successful investors
Mm-hmm.
make mistakes.
Yeah, you're going to...
The key is to
Yeah.
learn from those mistakes, adapt your approach,
Right.
and never stop learning.
And speaking of learning,
Yeah.
let's dive into another key aspect
Okay.
of Graham's philosophies.
All right.
Navigating market fluctuations.
A whole big one.
He dedicates a whole chapter to this.
Yeah.
And in today's world of, instant information and 247 news cycles,
It's more relevant than ever.
it feels more relevant than
It
ever.
really does, yeah.
Graham was writing in a time when getting stock quotes was a much more cumbersome process.
It was.
You had to call your broker,
Right?
wait for the newspaper,
Well-
or even physically go down to the ticker tape
Yeah.
to see how your investments were doing.
It's hard to imagine that world now, isn't it?
Yeah,
We have constant access
to everything, yeah.
to market data, news, expert
All at
opinions,
our fingertips.
which can be both a blessing and a curse,
Right.
right?
Because
Particularly spec.
yeah, it's so easy to get caught up in the minute by minute fluctuations of the market.
The ups and downs, yeah.
You feel like you need to react to every piece of news,
Yeah.
every price change.
Tempting, yeah.
And that's where Graham's advice becomes even more crucial.
I agree.
He argued that
That,
the more frequently you check stock prices,
yeah,
the more likely you are
more likely.
to make emotional decisions, to
Right.
buy high and sell low.
The classic mistake.
Yeah.
Yeah.
And he even went so far as to say that the average investor
Yeah.
would be better off if his stocks had no market quotation at all,
Wow.
for he would then be spared the mental anguish caused by other person's mistakes of judgment.
That's a pretty radical statement.
Even by today's standards?
It is. It makes you think, though, right?
It does.
How much of our anxiety and stress as investors
Yeah,
is self-inflicted?
right, right.
How much of it comes from constantly monitoring the market
Yeah.
and reacting to every blip on the radar?
So here's a question for you and for our listener to ponder. What if we all took a page from Graham's book
Yeah.
and disconnected from the constant stream of market data?
Right.
What if we focused instead on the fundamentals,
The fundamentals
of
out.
the businesses we own,
Yeah.
on the long-term prospects of our investments,
Hmm.
and on our own individual financial goals?
It's an interesting thought experiment, isn't it?
It really is.
To step back from the frenzy
Yeah.
and reconnect with the principles of intelligent investing.
Maybe that's the true path.
Maybe it is.
Becoming a more successful
Yeah.
and a more serene investor
Serene, yeah.
in the 21st century.
That's a good point.
It's like finding that inner peace amidst
The chaos.
the chaos of the market.
I like that.
And, speaking of those super investors
Yeah.
who followed Graham's path,
Uh-huh.
one striking similarity
Similarity.
is their long-term focus.
Yeah.
They weren't chasing quick profits
Right.
or trying to time the market. They were
Right.
buying businesses they understood and believed in
Right.
with the intention of holding them
For years.
for years, even decades.
That's a stark contrast.
to what we see today
To what?
with the day trading mentality.
That's so.
right?
Yeah.
People jumping in and out of stocks,
Trying to make a quick buck.
trying to time the market. Yeah.
It's almost like they're treating the market like a casino,
which is
which is exactly what Graham warned against.
exactly.
And I think that that long-term focus
yeah.
is a key ingredient in those super investors' success.
Uh-huh.
It allowed them to ride out the inevitable
Market fluctuations.
market fluctuations. Yeah.
And benefit from the power of compounding,
Compounding.
which Einstein called the eighth wonder of the world.
Compounding. Now that's a topic I could geek out on for hours,
We could do a whole other episode on that.
but I'll spare you and our listeners for now. Okay.
But before we get completely sidetracked,
Yeah.
let's circle back to those super investors.
Right.
Besides their long-term focus,
Mm-hmm.
what else set them apart from the average investor?
Well, they weren't afraid
Weren't afraid to.
to be contrarian,
Okay.
to go against the crowd.
Okay.
When they saw an opportunity,
Okay.
several of them made their biggest gains
Okay.
by buying companies that were
Out of favor.
out of favor, yeah, that Wall Street had written off.
Interesting.
They were willing to be patient,
Yeah.
to wait for the market,
Okay.
to recognize the true value
Right.
of those businesses.
Like buying those cigar butts that Graham talks
the
of.
cigar butts, yeah,
Undervalued company.
with maybe one good puff left in them.
Yeah. Yeah.
It's about finding those hidden gems, those diamonds in the rough
Right.
that the market has overlooked.
And it's a reminder that being an intelligent investor
Mm-hmm.
often means thinking differently,
Yeah.
questioning assumptions,
Uh-huh.
and not being swayed by the herd mentality.
Right.
It's about having the courage to go your own way, to trust your own analysis,
Mm-hmm.
and to stay true to your investment philosophy.
Perfectly said.
And that brings us back to one of the most important concepts
Yes.
Graham introduced,
Protect.
the margin of safety.
Yes.
He argued that this is the central concept of investment,
It is.
the key to minimizing risk
Uh-huh.
and maximizing returns.
Yeah, he provides a really clear explanation
Oh, does he?
of what that margin of safety looks
Let him
like
practice.
in practice. Yeah.
Okay, so what does it look like?
He compares the earning power of stocks
Okay.
to the interest rate on bonds.
Uh-huh.
arguing that a healthy margin of safety
Okay.
exists when the earning power
Okay.
of a stock
Mm.
significantly
Of
exceeds
Dixter.
the
Okay.
interest rate
Okay.
on a high-grade bond.
So you're essentially getting a much higher return on your investment
Yeah,
with the stock,
with a stock.
even if it's a bit riskier
It is. It is.
than to settle for a lower return on a safer bond.
That's right.
Okay.
Because with the stock, you have the potential
Potential for.
for both income and growth.
Right, right.
But the key is to buy that stock at a price
Okay.
that's significantly lower
Lower
than
than.
its intrinsic value,
Right, okay.
which is where that margin of safety comes in.
And Graham suggests that this principle can be applied
Yeah,
beyond just stocks, right?
absolutely. He talks about using it for bonds, real estate,
Okay.
even private businesses.
It's about having that built-in cushion, right?
Yes, that extra layer of protection
Extra layer, okay.
against unexpected events
Right.
or mistakes in judgment.
You know, it's funny, we live in a world that's obsessed with speed,
Yeah.
instant gratification. But Graham's philosophy is all about patience,
Yeah.
discipline,
Yeah.
and taking a long-term perspective.
It's almost like he's encouraging us to slow down,
Yeah.
to think more deeply
Think more deeply, okay.
about our investments.
Okay.
And to resist the urge
The urge to
chase quick profits.
And that can be a challenge
You can.
in today's fast-paced market.
It can be tough.
But it's a challenge worth embracing because the rewards can be significant.
They can be huge.
Remember those super investors we discussed?
Yeah.
They all achieved extraordinary results
Right.
by following Graham's principles.
Yeah.
And one of their defining characteristics
Was
was their long-term focus.
Long-term focus, yeah.
They weren't day trading
No.
or trying to time the market.
Right.
They were buying businesses they believed in
Uh-huh.
and holding them for years, even decades.
It's amazing how a simple concept like patience
Yeah,
can have such a profound impact
it really can.
on your investment success.
Yeah, it's a reminder that sometimes the best approach
It's just to
is to simply stay the course.
stay the course. Yeah,
Let your investments do their work.
that's right.
And another trait those super investors shared was their willingness to be contrarian,
To be contrarian, yeah.
to think differently from the crowd.
That's right.
They weren't afraid to buy companies that were out of favor,
Out of favor, yeah.
that Wall Street had written off.
Yeah, they saw value where others didn't.
They were like those bargain hunters
Yeah.
who can spot a hidden gem in a pile of junk.
That's a great way to put it.
And it highlights another key aspect of Graham's philosophy,
Which is?
independent thinking.
Independent thinking, yes.
He encourages you to trust your own analysis,
Yeah.
do your own research,
Uh-huh.
and not be swayed by the
By
herd mentality.
the herd mentality, right.
So as we approach the final part of our deep dive into
Okay.
the intelligent investor,
All right.
what's one thought-provoking question you'd like to leave our listening with?
I think the most important question
Okay.
any investor can ask themselves
Yeah.
is, am I investing
Am I investing?
or am I speculating?
That's a great one because as we've discussed,
Yeah.
the line between those two
Yeah,
can sometimes be blurry.
it can be.
And the answer to that question
Right.
will guide, everything
It will.
from your investment strategy to your risk tolerance.
To your long-term expectations.
Yeah, to your long-term expectations.
So if you find yourself
Yeah.
chasing hot stocks,
Okay.
trying to time the market,
Right.
or making decisions based on emotion
Yeah.
rather than analysis,
Okay.
maybe it's time to step back
Step back and
and reconnect with the principles of intelligent investing
that Graham
so eloquently.
so eloquently laid out.
That's right.
Because as Graham reminds us in the long run,
Yeah,
it's not about beating the market or getting rich quick.
right.
It's about achieving your financial goals,
Yeah.
protecting your capital,
Uh-huh.
and building a secure future
Yeah.
for yourself and your family. Expert speaker. All right, we're back for the final part of our deep dive
Into the intelligent investing.
into the intelligent investor. We've covered so much around
I
already.
have.
But I'm excited to see where this journey takes us next.
Well, we've talked about the importance of thinking for yourself,
Right.
understanding market history,
Yeah.
valuing companies like a pro.
Mm-hmm.
But even with all that knowledge,
Yeah.
there's still one crucial element
Okay.
that Graham emphasizes,
Mm-hmm.
managing risk.
Okay.
And that's where his margin of safety principle comes in.
We touched on this earlier,
We did.
but I think it's worth revisiting, especially for our listener
It is.
who might be new to this concept.
Uh-huh.
Can you remind us what the margin of safety is all about?
So it's all about buying assets for significantly less
Less than.
than their intrinsic value.
Okay.
It's like getting a deal,
Yeah.
a built-in buffer
Okay.
to protect you from
Protect you from.
those inevitable market swings.
Yeah.
And even your own mistakes in judgment.
You're going to make some.
It happens.
Okay.
Think of it as a safety net for your investments.
Okay, that makes sense. But how do we actually calculate that margin of safety?
All right.
It sounds a little complicated.
Well, Graham compares the earning power of stocks
Okay.
to the interest rate on bonds.
Okay.
He says a healthy margin of safety exists
Exists when?
when the earning power of a stock
Mm-hmm.
significantly exceeds
Okay.
the interest rate on a high-grade bond,
So you're basically saying it's better to get a higher return
a higher return.
on a stock, even
Yeah.
if it's a little riskier,
Yeah, it is a little riskier.
than to settle for a lower return on a safer bond.
That's right.
Because
Because
with the stock, you have the potential for
Yeah.
both income and growth.
that's the key.
But the key is
Yeah.
to buy that stock at a price that's significantly lower than its intrinsic value.
which is where the margin of safety comes in,
And Graham suggests this principle
can be applied.
can be applied beyond just stocks, right?
Absolutely. He talks about using it for bonds,
Okay.
real estate, even private businesses.
So it's like a
universal principle.
universal principle of investing.
Yeah.
It can help you
Minimize risk
minimize risk and maximize returns.
across your entire portfolio.
It's funny. We live in a world
Yeah.
that's obsessed with speed,
Yeah.
instant gratification.
Right.
But Graham's philosophy,
It's all about.
it's all about patience,
Yes.
discipline,
Uh-huh.
and taking a long-term perspective.
He's encouraging us to slow down.
Yeah, to think more deeply
Think more deeply.
about our investments.
Yes.
To resist the urge to chase
To chase.
quick profits.
Yeah. And that could be a challenge.
It's a big challenge.
It could be tough.
in today's fast-paced market.
It can.
But
But
it's a challenge worth embracing because
Yes.
the rewards can be significant.
they could be huge.
Remember those super investors?
Yeah, the super
we
investors.
discussed?
Mm-hmm.
They all achieved
Extraordinary results
extraordinary results.
by following Graham's principles.
And one of their defining characteristics was
Yeah.
their long-term focus.
Their long-term
They
funds.
weren't day trading.
Right.
They weren't trying to time the market. They were buying businesses
That they believed in.
that they believed in, yeah, and holding them for years, even decades.
It's amazing how, how a simple concept like patience
Yeah,
can have such a profound impact
it really can.
on your investment success.
It's a reminder that sometimes the best approach is
The best approach is
to
to
simply stay the course
stay the course, yeah.
and let your investments do their work.
Let them do the work.
And another trait
Yeah.
those super investors shared
Was
is their willingness to be contrarian,
to be contrarian, yes.
to think differently
To think differently.
from the crowd.
From the crowd, yeah.
They weren't afraid to buy companies
That were
that were out of favor,
out of favor.
that Wall Street had written off.
They saw value where others didn't.
They were like those bargain hunters who can spot a hidden gem
A hidden gem.
in a pile of junk.
That's a great way to put it.
It highlights another key aspect of Graham's philosophy,
Which is
independent thinking.
independent thinking.
He encourages you to trust your own analysis,
Yeah.
do your own research,
Uh-huh.
and not be swayed by the herd
By
mentality.
the herd mentality.
So as we wrap up this deep dive into the intelligent investor,
Oh, what?
what's one final piece of advice you would give to our listener
Okay.
who's eager to put Graham's wisdom into practice?
I would say
Yeah.
start by asking yourself that crucial question,
Okay, the one we discussed earlier.
the one we discussed earlier.
Yeah.
Am I investing?
Am I investing?
Or am I speculating?
And if
If you're
yeah.
honestly engaging with that question,
Yeah.
you're already on the right path.
And once you've answered that question,
Yeah.
remember the key takeaways
From our journey,
from our journey.
embrace the principles of patience,
Okay.
discipline,
Mm-hmm.
and a long-term perspective.
Don't be afraid to
Don't be afraid to
think differently.
Yeah.
To be contrarian
Uh-huh.
and to challenge conventional wisdom.
Do your own research.
Yeah.
Understand the businesses you're investing in.
Mm-hmm.
And always look for that
That
margin of safety.
and most importantly,
It's important.
remember that investing is
Yes.
a journey.
It is.
Not a destination.
It's about learning,
Yeah.
growing, and adapting
along the way.
on the way.
So to our listener,
Yes.
thank you for joining us
Thank you.
on this deep dive into
The intelligent investor.
the intelligent investor. We hope we've gained some valuable insights.
We do.
And tools to help you
Yeah.
navigate the complex world of investing.
It is a complex world.
And remember,
Yeah.
the journey to becoming an intelligent investor
Starts today.
starts today.